Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Thursday the 7th of May. And thank you for listening and for making us one of the most listened to business and finance podcasts in Hong Kong and Singapore, according to Pod Status. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, Emmanuel Macron and Ursula von der Leyen warned President Xi Jinping on Monday that the EU needed to protect itself from cheap Chinese imports, and they also urged China's president to curb support for Russia in its war in Ukraine. We will defend our companies, we will defend our economies, Mrs von der Leyen, European Commission President, said after meeting President Xi in Paris at the start of his 5-day trip to Europe. The world can't absorb China's surplus production, Mrs von der Leyen said. President Xi said whether viewed from the perspective of comparative advantage or global market demand, there was no such thing as China's overcapacity problem. A private survey showed the expansion in China's services activity slowed slightly in April from March. The Caixin S&P Global Services PMI came in at 52.5 in April, ticking down from 52.7 in March, and matching forecasts. It was the 16th straight month of growth in services activity, with new business growing the most in nearly a year, and sentiment improved to a 4-month high. And business conditions across the Hong Kong private sector continued to improve, albeit at a slower pace in April. The S&P Global Hong Kong PMI fell to 50.6 in April from March's 3-month high of 50.9. Still, it was the second straight month of growth in private sector activity. Sentiments, though, remain downbeat, reflecting increasing competition and subdued economic conditions that affected sales. Indonesia's first quarter GDP climbed 5.1% year-on-year, marking its fastest expansion in 3 quarters. The reading also beat the 5% growth expected by economists and the 5% rise in the final quarter of 2023. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Gary Young, Senior Economist for Asia Pacific Thematic Research at Natixis, and our US Economics Correspondent, writer and broadcaster Barry Wood over in Washington DC. And as usual, if you want to get in touch with any questions or comments, please go to my website, peterlewismoneytalk.substack.com, and while you're there, take a look at my Asian daily newsletter, which is updated every business day. Money Talk. US stocks rose on Monday following last week's soft jobs report, which showed hiring had slowed and unemployment had ticked up. That's prompted traders to increase bets that the Fed will cut interest rates between 1 and 2 times this year, with the first reduction beginning in September. The Dow climbed 177 points, or 0.5%, to close at 38,852. It was the 4th consecutive winning session for the Dow. The S&P 500 advanced 1% to end at 5,181. The Nasdaq Composite gained 1.2% to reach 16,349, with Nvidia, Micron Technology, Meta and Netflix helping to lead the gains. Rate-sensitive small caps saw outperformance, with the Russell 2000 index gaining 1.2%. Treasury bonds stabilised following a multi-session rally since last Wednesday, when Federal Reserve Chairman Jerome Powell said the US Central Bank's next policy move was unlikely to be a rate rise. The yield on the policy-sensitive 2-year note was up 3 basis points to 4.83% Monday, and the yield on the growth-sensitive 10-year note was 1 basis point lower at 4.49%. The US dollar paired initial weakness, with the US dollar index ending the session flat at 105.09. The Japanese yen was 0.6% weaker versus the buck, ending at 153.88 yen per dollar. However, the yen still remains well below that 160 peak seen last week before the suspected Japanese government interventions. Gold prices extended gains from Friday's bounce, ending 0.9% higher at $2,324 an ounce. Oil prices saw a choppy session amid conflicting headlines in the Israel-Hamas peace deal proposals, but they ended the day higher, with Brent settling 0.4% firmer at $83.33 a barrel. And an early surge in Bitcoin, up to $65,500, was quickly sold into. The cryptocurrency ended the day 0.6% higher at $63,325. Here in Hong Kong, the Hang Seng Index rose 102 points, or 0.6%, to an 8-month high of 18,578. The city's benchmark index has climbed now for 10 consecutive sessions. That's the longest winning streak since 2018, and the rally has helped the index to gains of over 24% from the January lows, putting it back in a bull market. The tech index was up 0.9%, and mainland investors bought over 5 billion Hong Kong dollars worth of local shares on Monday. That's the biggest single-day purchase in over 2 weeks, according to Stock Connect data. Mainland China's Shanghai Composite Index rose 1.2% to close at an almost 8-month high of 3,141 as traders returned from the Labour Day holiday. And futures markets pointing to an almost flat open for the Hang Seng this morning, starting at around about 18,580. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this bright Wednesday morning, at least where I am, it's time to welcome our guests. We have with us our regular, not Wednesday, is it? It's Tuesday. I'm wishing the week away already. We have our regular Tuesday commentator, Mark Michelson, who's chairman of the Asia CEO Forum at IMA Asia. Morning, Mark.
Good morning, Peter. Good evening, Barry.
And also joining us is Gary Young, who is senior economist for Asia Pacific Thematic Research at Natixis. Morning to you, Gary.
Good morning. Hello, everyone.
And over in Washington, D.C., as always on a Tuesday morning, we have Barry Wood, our US economics correspondent, and it's traditional to get a Washington, D.C. weather forecast at this time in the morning. Last time we spoke, it sounded like you'd skipped out spring altogether and gone straight to summer from winter.
Yes, and that changed again, Peter. Then we had 3 days of rain, 3 consecutive days of heavy rain. So all of those blossoms that I was praising as a beautiful scene for any visitor to Washington, that's gone. So now it's quite warm. It's probably 25 degrees, still cloudy, but the blossoms are finished.
The blossoms have been washed away. If you want to see things washed away, you should have been here in Hong Kong last Saturday. All right, let's start with some business stuff. Emmanuel Macron and Ursula von der Leyen warned President Xi Jinping on Monday that the EU needed to protect itself from cheap Chinese imports. And they also urged China's president to curb support for Russia in its war in Ukraine. Mrs. von der Leyen, who is the European Commission president, said after meeting President Xi in Paris at the start of his 5-day trip to Europe that we will defend our companies and we will defend our economies. She added the world cannot absorb China's surplus production, and she added that she would closely coordinate with G7 countries and emerging economies that were impacted by China's market distortions, as she called them, and would deploy all the tools available to defend its economies if China fails to offer fair access to its markets. President Xi said whether viewed from the perspective of comparative advantage or global market demand, there was no such thing as China's overcapacity problem. Well, Mark, maybe I can ask you to kick off. This sounds like it's going well, doesn't it? The EU not backing down on its claims that China is overproducing, and President Xi Jinping saying there's no such thing.
Well, technically, it's hard to argue, right? But there's a feeling among our clients, among Europeans. European Chamber of Commerce in China, for example, just had a meeting, and that's what they talked about. And they believe it's a systemic problem, not a cyclical problem, and is a problem for competition. They think that China has some ways out, and they might be able to modify it. But also, there's a question of the China model, if there is such a thing. And it's not just China, but others as well. They tend to support certain industries at certain times. They're favored, and so they get a lot of the money. They get a lot of the support. EVs is a good example, and then there are a lot of them. And then you have to rationalize to some extent. As I think I mentioned in a previous program, one of the leading China EV makers was complaining about this a few weeks ago in Hong Kong. Of course he would, but there are too many. So at least that's the perception. And when you get the reaction that there isn't a problem, that doesn't help, because there needs to be some sort of working out of this. And I expect there will be, but at the moment, it's one of those issues that some companies are facing.
Gary, Mark says his members, his businesses are saying that they have a feeling that there is overcapacity, that there is overproduction, Is there anything we can point to that's more than just a feeling? Is there any data, any evidence that there is an overcapacity problem in China? And if so, how do we measure it?
Well,
Very
I think it is
interesting.
indeed a very
Go ahead, Gary.
difficult question indeed, right? Because I mean, you can think of it from the China's perspective that well, maybe China is producing more than it needs. I think this is quite a clear trend, because otherwise it won't keep exporting, right? But whether China is actually producing more than the world actually needs, I think that is a way more difficult and as you said, interesting question to look at, but of which we don't really have an answer yet. So I think this is where we are right now. But given the fact that China is actually gaining ground in a lot of key new sectors, electric vehicles, batteries, solar panels, which already from 4.2% of total export right now, then I wouldn't be surprised that, from the corporate profit point of view, and of course it's a challenge to many existing leaders, and also because China's role in the global manufacturing sector, right? So if China actually increase production, it will have a spillover effect. It's much different than other, smaller manufacturing players. So yeah, I mean, it's a very difficult question.
Could we look at things like capacity utilization rates on the mainland, which are coming down, aren't they? So that would suggest that if there was strong domestic demand, the capacity utilization rate would be much higher, because you'd have people on the mainland willing to buy these products. So the fact that it is coming down quite rapidly, is that something that would suggest maybe there is overproduction? Certainly in certain sectors. You can't say it across the board, can you? But maybe in certain sectors.
Well, yes, definitely. Please continue.
Well, I was going to say, Gary, and in answer to what you just mentioned, Peter, that I don't think there's any doubt that China is overproducing. Think of the analogy of the United States or Western Europe. If you produce, let's say you're General Motors, and you produce, you have an internal count of how many cars you want in a quarter. Well, if you don't sell them, they just accumulate on dealers' lots or in the parking lots of the manufacturer. We don't have the advantage in Europe and in the United States of simply saying, well, hold it, these are good products. The price, even if we cut it beyond what is, in fact, normally the price, will still be profitable for us. So you export all of this. And I think that's exactly what's happening in China. They have this unique advantage of having a very low cost structure. And they can say, as I think President Xi is suggesting, hold it, these are great products. We're helping you. We're bringing down the inflation rate by offering these vehicles. So, yeah, I think there's no doubt that they're overproducing. And I think we're into a repeat of the situation that existed 20 years ago.
Yeah.
There's an economist in Hong Kong, Stuart Patterson, who wrote a book about this. And China exports deflation. At that time, the issue was deflation. They were forcing down the price level in Europe and the United States. Now, I think they're just going to sell these cars. Well, I'm saying cars, but I think that's the most visible part of their overproduction at low prices, and they're going to make money, and they're going to disrupt domestic producers in Europe and America.
Yeah, I just want I agree, Barry. Here we go again, to quote a former president. But the other thing that was brought up at the European meeting, and we've also heard, is that overcapacity and weak demand has caused imports to decline, with to some extent domestic goods replacing imported ones, which has hurt international companies. Chemical companies were particularly complaining about this. Now, this might be temporary. Hard to know how pervasive this is, but that's another side issue, I guess.
Gary, coming back to that issue of capacity utilization, is that one way of looking at this and seeing if there is in certain sectors anyway over capacity? I mean, the trouble is, it's a very nuanced thing, isn't it? It's not the same across all the manufacturing sectors at all.
Well, yes, indeed. I think first, the more difficult question is, what is really the ideal utilization rate, right? Because generally in the world, like the common norm is 75%, which is kind of like a benchmark for most countries. But in the case of China, because of the low cost, massive labor, etc., so a lot of Chinese firms actually tends to build more capacity so that they can compete on prices with firms from other countries as well. So which bring it to a generally lower level. So what we can do here is really compare different sectors versus the historical average, and we do see that, for example, in some of the sectors like automobile and tech, building materials, and you can imagine, right, this is quite linked to the downturn of the tech cycle last year, the crackdown of real estate in China in recent years, and etc. And also with the massive investment in automobile, all of these factors actually fit into the fact that, the utilization rate in all these sectors are actually falling in China, which basically show the fact that I think a lot of firms may get more difficult in terms of how to use the domestic demand to fit into their revenue, and eventually they may need to export more. So I do think that probably there's some signs of overcapacity in China, this is for sure, but how much it can export the way out and whether the world actually can absorb all this demand, then that is another question. But I wouldn't be surprised to see prices falling further in at least the coming 12 to 18 months.
It's hard to see, isn't it, how in some areas how prices can fall very much more. I mean, if you look at, for example, BYD, it's got an electric vehicle that it sells for $10,000. It's almost impossible to imagine how firms like Toyota and Volkswagen, other global firms, can possibly compete with that.
Yes, some of us
I think that's really
can take advantage of that too.
Yeah, that may be, but the fact is, Peter, you're correct. There's no way that European and American manufacturers can compete with a $10,000 high quality electric car.
No,
and this is why I think we're probably headed for another trade war, because the Chinese will probably have to accept the demands put by Ms. van der Leyen and by Mr. Macron is to say, hold it, cut back on these exports. Don't flood our markets or we're headed for trouble. And I think that's anathema to President Xi. So we'll have to see how this plays out. But, the quotes that you mentioned, Peter, of Macron saying this is a historic turning point in terms of our economic relation, or van der Leyen saying the European Union must protect itself against unfair competition. This is all mirrored in the United States. Exactly. It's as if Janet Yellen and her colleagues were speaking as instead of the Europeans.
What Barry just said was part of the conclusion of this European meeting, that trade tensions are going to get worse vis-a-vis Europe probably, and the U.S. as well, before they get better. And so governments trying to use traditional defense tools. They didn't have a great experience with solar panels, especially in Europe, in terms of competing. So they're going to try to do something else. And one of the proposals, which I think one of the executive vice presidents of the EU mentioned, was a trustworthiness model, whatever that means, to ensure the products entering the European market are trustworthy, which means having to do with cybersecurity, labor rights, etc., which obviously is highly subjective and, sounds to me like it could cause more problems than solve them. But this is the situation we're in.
So what's the way out? Because as Barry says, we're heading for a trade war here, aren't we? If you look at the language that Ursula von der Leyen was using, we're going to defend our economies, we're going to defend our companies, we're going to use every tool at our disposal. President Xi denies even that there is overcapacity. It seems like unless something gives, this is going to be a trade war.
Yeah, I think
that's the case.
Yeah,
I think that's the case. And Mark, you may have a different perspective on this. The problem is that it's as if President Xi and his economic colleagues and the Europeans are talking past each other. I don't think there's no common ground here. Now, when President Xi gets to more friendly territory in Serbia and in Hungary, those issues don't exist.
Yeah.
They'll be happy to take very low-priced automobiles. And then they can talk about the Belt and Road Initiative, and they can talk about the port of Piraeus and the new rail line that's being built from Piraeus in Greece right through Macedonia, North Macedonia, Serbia, and up into Budapest. But for the Europeans, von der Leyen and for Macron, this is serious stuff. And we know where Olaf Scholz is. He's even stronger against what the Chinese are allegedly doing.
Yeah, the hope is cooler heads will prevail somehow. But at the moment, Europeans are being their elections, coming up in France and not too distant future in other areas where this is an issue, obviously in the United States and so on. So from that perspective, I'm not sure that it's going to get better very quickly.
Well, indeed, I just want to add one more point beyond the fact that many people would talk about the overcapacity issue between China versus the West, right? Indeed, we do see restrictions and worries beyond the West in countries such as India or Turkey or recently Mexico. The latest example may be a bit related to the US, but still, I think it seems to me that it has developed into a broader common worries globally on this issue of overcapacity and whether it exists or not in a lot of government policy making.
Gary, is the way out of this, or one potential way out for China, for President Xi, to stimulate domestic demand? Because if there was more domestic demand, and we know that's weak on the mainland at the moment, then Chinese automakers can produce as many vehicles as they like, providing they're being bought in China by consumers in China. No one would care then, would they? No one would complain. So it's maybe one of the solutions, which will be good for the economy overall anyway, for China, rather than focusing on the supply side, which lots of its economic stimulus tends to do, is to focus more on the demand side and try and boost domestic demand in various ways.
Well, I think this is definitely true, but the problem is that when we look at the policies in the past 5, or I would even go all the way to 10 years, right? I don't think the Chinese government is changing the policy direction. It's all about supply. It's all about gaining upper edge in terms of technology. So everything that the government is trying to do is trying to support the growing supply. So, of course, we have seen some policy in tax cut, etc., to boost the demand in automobile and etc. But I simply don't think that will be a very big policy change. So that is actually one of the solutions, but I just don't think Beijing is considering that much versus the goal that you want to have on the possibly become the leader in a lot of these supply-driven industries.
Yeah, I agree with Barry. And in our members, and it's not across all industries, but on a lot of them, consumer confidence is still a problem. Spending is still underperforming, not just in cars and in other areas, and this is in China. So they have to figure out what some other approaches might be. And there are also the domestic competition is very strong in a lot of different areas, not surprisingly. And so new models all the time coming out. That's typical. That's the old Japan pattern as well. And so you have to run to compete, especially for international companies.
It seems to me, to pick up on what Gary was just saying there, that if you as a country have a policy which is constantly focused on the supply side, producing in certain sectors, not on ensuring there's enough demand, and then wanting to export the difference overseas, you can't complain when eventually overseas starts thinking, well, hang on, we don't want to lose our car industries and our solar panel industries. We've got to take steps to protect them. So surely this is the natural consequence of China's domestic policies, isn't it?
I think you're spot on, Peter. And that wasn't the case. There wasn't that kind of response 20 years ago when there was this problem of China exporting deflation. We may, in a few months, find ourselves talking about that again. But there are a couple things that are different. One, the Chinese exchange rate of vis-a-vis the dollar is weak. That means that all these Chinese exports are very competitively priced. Very competitive price. And I know the Chinese don't like to talk about the China 2025 program any longer, but if you look at the 10 industries that the government and the local governments are supporting, and we don't know how much money they're spending, it corresponds. It's aerospace, it's ocean engineering, it's rail equipment, electronic vehicles, electrical equipment, that includes semiconductors, farm machinery, new materials, and biomedical equipment. Well, they're putting a lot of money into these things, and we really don't know the degree to which the actual capital investment is coming from the government versus coming from the companies.
Well, while we're talking about domestic spending, Gary, tell me a little bit about travel over the May Day holiday. It seems like China saw a big jump in the number of arrivals and departures during the May Day holiday from a year ago. There was about a 35% increase year on year. The number of arrivals and departures peaked on May the 3rd with more than 1.8 million. Mainland travellers accounted for more than half of all the trips on the mainland, about 4.77 million, while people from Hong Kong, Macau and Taiwan made 2.92 million trips. And the Ministry of Culture and Tourism said there was 295 million domestic tourist trips made during the May Day holiday. That was up 7.6% year on year and 28.2% from the same period in 2019. But this spike in numbers wasn't matched by an increase in spending. Tourism revenue was only up 12.7% from the year, and also if you look at what tourists spent, they spent on average 565 yuan this year. That's about $78, which is only up 4% year on year and below what they were spending back in 2019. So it seems, Gary, consumers are still watching carefully what they're spending their money on.
Yes, exactly. I mean, I think the data pretty much shows that things are still improving, but it doesn't mask the fact that there are two important points. First, there is indeed certain signs of consumption downgrade of people being more cautious in spending. And second, even if they decide to spend and they would rather spend on the services related sectors like tourism, but it doesn't mean they will spend more on other sectors like automobile, as we discussed before. So I think it pretty much shows that this consumer confidence issue remains a big problem for China nowadays, especially if you see the disposable income not growing as quickly as before. I'm not saying it's contracting, but from a level like 8-9% a few years ago to right now probably lower than 5%, that is already a very big decline for a lot of Chinese households already. Then, how can you expect people to get back the animal spirit in terms of thinking that the future is more optimistic, and therefore regardless of what data you see, then people will still try to spend, corporate will try to invest. I think we're still quite far from that right now.
I can only imagine that most of the tourists in Hong Kong from the mainland went back home saying, I can't believe how expensive Hong Kong is. Because, of course, the Hong Kong dollar has gone up just in parallel with the U.S. dollar vis-a-vis the renminbi.
That's part of it. The other part, I think you saw the reports for Hong Kong, sort of reinforce what Gary said about China, is the spending was less than people had hoped, except if it was near the harbor where people could see the fireworks. And then the spending was much better. But outside of that, it was a little disappointing, I think, for Hong Kong retailers. So we got tourism, we got what of course were reported as good tourism numbers. They were on the face of it, but again, it's all about how much they spend and where they spend it.
Well, the Hong Kong government said the city saw about 766,000 mainland visitor arrivals over the 5-day break. What they didn't tell us was how many people left, and I think that was part of the problem, because if you look at those retail sales numbers, retail sales in Hong Kong down 7% year on year. Now that's the first time retail sales here have fallen for 15 months, and it's the most in 2 years. This suggests isn't there a systematic problem now in Hong Kong? There's a real change in consumer spending patterns, particularly with local Hong Kong people going to spend over the border.
Yes, I think I'll just add one more point here that not maybe the government doesn't want to touch it or not too many people may have mentioned it, is that in the past, I don't think it's a very like a strange phenomenon for a lot of Hong Kongers to spend money overseas for trips. I mean, it has been always the case. But the key changes right now is that first, the mainland visitors are not spending as much. This is true. But second, we cannot forget that there's also a group of more well-off middle class who may have left Hong Kong because of COVID or because of other reasons to or migrating to other countries, etc. So I think Hong Kong is actually losing the buffer that it's supposed to have from this relatively well-off middle class, that they're not in Hong Kong anymore, or even if they are, they don't want to spend as much money here. So I think this is also one of the problems that I see right now. It is indeed a structural like a transformation period that Hong Kong will need to face in retail. It's not cyclical.
Yeah, and to just reinforce that as well, and this is just what you've seen. I'm not sure of how the numbers support this, but in areas that catered especially to longtime residents and international tourists, they've been hurt. These are restaurants, these are retail shops. Sai Kung, for example, a lot of shops have closed on Wyndham Street toward Lan Kwai Fong and Soho. Yes, there are boarded up buildings still. Maybe this will change, but certainly they've been affected. How much that affects the overall economy, I don't know, but certainly I think the spending areas have moved to some extent within Hong Kong, and that people don't go to some of the places that maybe used to be frequented by maybe different kinds of visitors and long-term residents, many of whom have left.
The model for the retail industry, it's got to change, hasn't it? I'm not sure what it's got to change into, but it can't rely on the old patterns of high-spending tourists coming here and buying watches and clocks and jewellery in fashionable stores in Causeway Bay. The model has changed, and our industry has got to change with it, because if we're going to be more like the mainland, then there's less reason for mainland tourists to come to Hong Kong in the first place, isn't there?
Well, I think that's true. I think I'll just add shortly. I do think that in the past, it's pretty much a shopping-centric model, which basically means that, well, it's cheap here. You can buy the goods that you want, so you just come in and shop. Oh, maybe at the same time I would do something else. But right now, it's really about a very experience-driven model, especially after COVID, and also because of the massive inflation globally, but not in China, right? So I think this change is not reversible, and then it simply shows the fact that Hong Kong will need to develop other type of attraction instead of just banking on the old type of model and just come and say that, okay, it's cheap to buy things here, it's tax free, so you should be here, because I mean Japan is even cheaper than Hong Kong and you can have other experience, right? Why wouldn't the Chinese residents go there, and even for Europe, etc., right? So I think it's indeed like a lost timing that the basically Hong Kong will need to find a new ways out.
Yeah, I think that's absolutely true. They have to rethink what they're going to do and what's going to be the attraction. Obviously, one of those attractions now are the sites of Hong Kong and historical sites, and some of those places are being overwhelmed. Even a couple of the universities are putting restrictions on entry, or because they're being overwhelmed by tourists. That's a good thing. I don't think that contributes much to income.
You need a student card to buy the food and drinks in the university right now, because there are too many tourists. Yeah,
that's right.
Okay, let's turn our attention to the US. I want to talk about the non-farm payrolls with you, Barry. Non-farm payrolls increased by 175,000 in April. But that was down significantly from 315,000 in March. It was also well below the 241,000 forecast by economists, and it was the smallest rise in non-farm payrolls for 6 months. The unemployment rate rose to 3.9%. That's now the highest level since January 2022. And average hourly earnings rose 0.2% from the previous month, on a yearly basis up 3.9%, compared with 4.1% in March and 4.3% in February. Barry, every month we talk about these job numbers with you, and we've really each month been talking about just what a blowout surprise the numbers have been. This is the first one, I think, isn't it, market for quite a while, which has come in significantly below expectations.
Well, that's right. And how did the markets respond? By saying this is a fantastic number, because it shows that the economy is slowing as the Federal Reserve wants it to slow. And that means we're going to get interest rate cuts. 2 days earlier came Jerome Powell, whose press conference, I think, was highlighted by the statement, we have no plan to raise rates. So, all right, we're not getting a rate cut in June, but we may get one in July, and we're likely to get one in September. So the market loved that reduced number that you emphasized, Peter, because it says it's all working, coming together. You might say it confirms this is a kind of Goldilocks economy.
Is this the sort of jobs report the Fed wanted to see, do you think? This is what they've been looking for a while?
Absolutely, yes.
Mark and Gary, what are your thoughts about this? I mean, it's certainly not a bad number, is it? When you're creating 195,000 jobs a month, that's still not too shabby.
No, it's not too. It's not too bad. I mean, I think the concern is the same as everyone there. They're getting mixed messages, right? As Barry pointed out, is there going to be a cut? When's the cut going to be? And then one Fed official suggested that maybe there could be an increase if things turned, and that's the worry. Of course, is no one's quite confident that this is still going to go forward. It's been better than anyone expected, I think, in the past, and that's a worry. But I think I agree with Barry that generally speaking, this should be pretty welcome news to the business community too, for now at least.
Well, yes, I also agree with the trend that things would probably start getting a little bit worse going forward. So the market would love that, which is very ironic, right? So, but at the same time, I do think that one data point may not be that strong enough to really convince the Fed to act. Because if you think of it like before, there's always critics about saying the Fed hasn't acted early enough because of different reasons. I mean, people kind of don't believe anything is transitionary right now. So I think we do need to see more solid evidence to convince the Fed to actually act. But of course, what the market price would be different from, when the Fed actually eventually act from the policymaking point of view.
Do you think the Fed is itching to cut rates, or are they happy just to sit back at the moment and see how things go? I mean, as you mentioned, we're going to get another jobs report before the Fed meets again anyway. So have they got sort of twitchy fingers and want to press the rate cut button, or are they happy, if necessary, just to sit here all year and wait and see how things go?
Well, certainly they're happy to wait another month, and there's no sense of panic. I think they're satisfied. And, this when you have an unemployment rate in a full employment economy, an unemployment rate of 3.9%, that's a good number. 20 years ago, they would talk about 6% as being, almost full employment. I mean, it seems bizarre to say that now. So, yeah, I think the Fed is happy. And we can see that the remarks on Monday were all over the board. That Jay Powell loves that. He said, we're not a unified group. We're not all singing the same tune. We have diverse opinions. But on balance, that was a very good number that came out Friday. And I think the stock market rise and the stock market rise on Monday confirm that.
However, is the focus, though, still mainly going to be on the inflation numbers? Because this sort of jobs number doesn't get away from the fact that inflation is still sticky above 3%, does it? Is that the main issue that the Fed is still focused on?
I think so, yes.
So if you've got a Fed that says, the Fed chairman says, we are not going to raise rates, the best that's going to happen is they're going to stay here, but hopefully they're going to come down. Really, you ought to be going out there in the market and buying these short-dated treasury bonds where you can get 2-year yields at 5% and a Fed that says we're not going to raise rates. It almost seems to me there's a risk-free trade there to be done.
Peter, you revealed yourself as a bond trader.
In a previous life. I know. It's all come out now, hasn't it? What do you think, Gary? Do you think there's a good trade here, isn't there, in the bond markets when you've got a central bank, well, the Fed, not any old central bank, the Fed says we are not going to raise rates, and there you go. You can go and get 2-year yields at 5%.
Well, I mean, to a certain extent, I think it's true. But again, I do think that, yes, there's a certain commitment from the central banks nowadays, right? But sometimes investors will actually think, how valid are these commitments? So there could also be different type of market pricing. For example, earlier this year, right, someone is calling for 250 basis point of interest rate cut or 150, etc. But now we are obviously at a much more narrow a range. So I do think that there could still be some risk and volatility from how the market read the economic data. But generally speaking, I'm not too worried about the Fed hiking further, but I would be a bit more worried about, in the long run, whether we can actually go back to that 2% inflation level, right? Because if you look at the geopolitical situation that we have talked about earlier today, and also the cost in green transition, etc. I mean, every policy nowadays that we see are trying to, lift prices to a certain extent. So interest rate would probably not go up as aggressively as before, but I have a bit of doubt on how fast it can go down unless we are really in a very severe hard landing situation.
And just to wrap up out here, we've got two central banks meeting this week. Australia today, the Reserve Bank of Australia will give its decision later on this morning. Malaysia later on in the week. Gary, what are we expecting there? But I think the consensus seems to be no change from those two central banks.
Well, yes, I think for now, no change seems to be the most likely scenario. For Australia, there is indeed still a bit of risk of the high inflation or the sticky inflation may still force the RBA to have some precautious move in coming months. But for now, I think it's more like wait and see. For Malaysia, again, status quo for now. But as in what we see in some of the other ASEAN central banks like Indonesia, if the Fed remains hawkish, and if we see the dollar continue to be very strong, and some central banks in Asia may decide that they will need to hike rates simply to stem off the capital outflows. So this is something that we should keep an eye on in coming months. But of course, the ball is definitely passed to the Fed.
This is the risk, isn't it? Particularly for the emerging market banks, central banks out here in Asia. They're seeing the yen slide to 160. It's putting a lot of pressure on all the currencies around the region. Indonesia's central bank said it's ready for the worst here in terms of providing support for the rupiah. Unless the Fed, signals soon that it's going to cut rates, I presume, Gary, this slide in Asian currencies is going to be very difficult to reverse.
Yes, indeed. I mean, if the Fed actually cuts, right, it doesn't only change the sentiment, but it's like a very solid 25 basis point, which is the most likely reduction in the real differential, right? Imagine no matter what the Bank of Japan try to do, it will never be able to match the pace of the US. This is why we see this massive volatility in the yen, which is also behind, why people want to rush there to spend their money, etc. So, I mean, a lot of central banks in Asia, they can try different ways to create buffers to minimize the impact. But again, at the end of the day, it still depends on the Fed.
And a lot of people don't believe in Japan. The Bank of Japan is going to move quickly in any direction, and they don't have the ability to do it anyway in many cases. I just want to, Gary mentioned Indonesia, and you mentioned that too in your briefing, Peter. It's becoming much more interesting to international companies. We're doing every year we have a session called Singapore Overnight, a major forum in Singapore, and it's going to be next week. And one of the topics is restructuring local operations in Indonesia and how you compete there more effectively, because there's still issues in Indonesia, always have been, especially for international companies, but it's looking more promising in many sectors. And also generally companies and seem a little bit relaxed about the political transition. They may not feel that way once it occurs, but certainly for now that it's going to go pretty smoothly and that it's going to continue, Indonesia is going to continue on a more friendly business-oriented policy. Not overly friendly, but perhaps more friendly than it was in the past.
How concerned are businesses by the slide in the rupiah and the rise in interest rates? Is there there's a worry that maybe this slide in the currency could undo all the good work that the government has done and the central bank has done in getting inflation down and under control, improving the balance of payments? Is there a fear that maybe this puts that into jeopardy?
Sure, that's one of the risk factors, and I expect we're going to hear a lot of that next week, and I'll be glad to come back and let you know what companies are thinking.
Sure, yeah, but it's an interesting market, Indonesia. We ought to talk about it more, I think, on this show. Well, thank you all very much. Great to hear your thoughts there. You heard Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia, Gary Young, who's senior economist for Asia Pacific Thematic Research at Natixis, and our US economics correspondent over in Washington, D.C., Barry Wood.
You're listening to Peter Lewis's Money Talk.
Money Talk.
And thank you for listening this morning. I'll be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Enzio von Pfahl, capital preservation specialist at Financial Shield, and Louisa Fock, who is China equity strategist at Bank of Singapore. And with a view from Japan is John Byrne, vice chair of research at the Asian Development Bank Institute. And if you want some more information on some of the top stories from the region, please take a look at my daily newsletter at peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk.